Are you overwhelmed by the endless sea of ETFs and unsure where to start? What if there was a straightforward portfolio you could build using only Schwab ETFs? Today, we're going to reveal exactly that, the only Schwab ETF portfolio you'll ever need. Why focus on just Schwab ETFs? Because they are low-cost and thoughtfully constructed. Keeping it simple means less confusion and more confidence in your investment choices. So let's dive in. If you could only pick 5 ETFs to build a smart, well-rounded, future-proof portfolio using only Schwab products, these would be it. We're talking income, growth, stability, global reach, all wrapped into one clean, easy-to-manage strategy. The best part? These funds are low-cost, tax-efficient, and accessible to everyday investors. If you're looking for dependable income without babysitting your stocks, SCHD is where you start. SCHD is built on quality, tracking the Dow Jones U.S. Dividend 100 Index. It handpicks about 100 financially solid, dividend-paying U.S. companies. Think of brands with strong cash flows, low debt, and a solid history of raising their dividends year after year. Right now, SCHD yields around 3.9%, which beats the average savings account by a long shot, with an ultra-low expense ratio of 0.06%. This ETF is packed with big-name players across sectors like consumer goods, healthcare, and industrials. During aggressive bull markets, dividend funds like SCHD can lag a bit. However, when markets turn shaky, SCHD tends to hold its ground better than your average growth fund. Bottom line, SCHD brings balance. It's built for investors who want quality, consistency, and a little peace of mind. Now, if SCHD is your foundation for income, SCHG is the rocket fuel. This fund is all about growth, specifically large-cap U.S. companies expected to expand earnings rapidly. SCHG tracks the Dow Jones U.S. Large Cap Growth Index, giving you exposure to companies like Apple, Microsoft, Nvidia, and other tech-driven behemoths. Over the past decade, this ETF has averaged over 15% annual returns, which is nothing short of impressive. But, and this is a big but, with high reward comes high risk. This fund is heavily concentrated in the tech sector. When tech soars, SCHG shines. But when the market turns against growth stocks, like it did in 2022, when the fund fell 31.8%, it's not for the faint of heart. This is the kind of ETF you load up on if you've got time on your side. SCHG can deliver serious upside over the long term. SCHG is not a set it and forget it for everyone, but it is a must-have growth engine for those looking to supercharge returns. Let's say you don't want to pick between income and growth. SCHB is your answer. This ETF tracks over 2,500 U.S. companies across all market caps. It's like buying the entire U.S. stock market in one neat package. Over the past 10 years, this ETF has delivered about 12% average annual returns, with a stunningly low expense ratio of just 0.03%. For every $10,000 invested, you're paying just $3 a year. Because SCHB is market cap weighted, it leans heavily on mega cap tech stocks. Your portfolio's performance is tied to giants like Apple and Microsoft. SCHB offers broad, efficient exposure and is an ideal core holding for almost any investor. It's simple, smart, and scalable. Let's zoom out beyond U.S. borders with SCHY, Schwab's International Dividend ETF. a gem for global diversification. SCHY targets quality dividend-paying companies across developed and emerging markets, including the UK, Japan, and Australia. U.S. investors often suffer from home country bias, over-investing in domestic markets and ignoring overseas opportunities. International stocks behave differently than U.S. equities, influenced by different economic forces. Adding SCHY introduces exposure to industries like banking, energy, and manufacturing, areas that balance out the tech-heavy U.S. market. With a dividend yield around 3.5%, SCHY adds meaningful income too. However, long-term data is limited since it launched in 2021. SCHY comes with currency risk and geopolitical uncertainty, yet it's powerful for a well-diversified global portfolio. Now let's talk defense. When markets tumble, bonds become your safety net. That's exactly what SCHZ offers. SCHZ tracks the Bloomberg U.S. Aggregate Bond Index, offering exposure to U.S. Treasuries and investment-grade bonds. SCHZ preserves capital, reduces volatility, and delivers steady income with an attractive expense ratio of just 0.03%. However, when interest rates rise, bond prices drop, which we've seen with SCHZ posting negative returns lately. Still, SCHZ serves a crucial purpose in the big picture, especially as you approach retirement. Think of SCHZ as the cushion that softens the blow during market downturns. It may not be exciting, but it's essential. You've got decades before retirement, which means you can afford to ride the market's ups and downs and benefit from the long-term power of compounding. Maximize growth. At this stage, you can go 100% into equities without losing sleep. Bonds can come later. Suggested allocation: 50% SCHG for growth, 30% SCHB for balance, and 20% SCHY for global exposure and dividend income. This is your growth engine. It focuses on large-cap innovators, mostly in the tech sector. High risk, high reward. Why not include SCHD or SCHZ yet? Because income and stability aren't your top priorities right now. You're playing offense, not defense. Your best asset isn't just time. It's your ability to stay invested when things get rough. This 100% equity mix can be volatile, sure, but the long-term potential, massive. For middle-aged investors, ages 40 to 55, growth with a safety net. Your priorities shift. Now it's about balance. You want growth, but also need protection. Suggested allocation: 40% SCHG, 25% SCHB, 15% SCHD, 10% SCHY, 10% SCHZ. SCHG remains the growth driver while introducing dividends and bonds for stability and income generation as you prepare for the future. This allocation flips the original script. Now, only 20% is focused on growth, while 60% is geared toward income and stability. It's a defensive portfolio that keeps pace with inflation. Think of this as your harvest and protect phase. You've planted and grown your financial garden. Now it's time to harvest the fruits without burning the field. These life stages aren't rigid boxes. You could be 38 with conservative instincts or 62 still running a business with no retirement plans. Know your time horizon and risk tolerance. The magic of the Schwab ETF lineup allows you to adjust the dials to fit your unique needs. Just 5 ETFs and endless possibilities without complications. Ask yourself, am I more concerned about protecting wealth or growing it? Can I handle a 20% market dip without panic selling? How soon do I need to pull money? Answering those questions helps you design an allocation that fits you, not just your age. Fees can quietly eat away at your investment returns. That's why low-cost investing has become such a big deal. Schwab absolutely shines in this area. Every ETF in this 5-fund portfolio comes with ultra-low expense ratios, ranging from 0.03% to 0.14%. Investing $10,000 in a Schwab ETF with 0.03% expense ratio costs just $3 a year in management fees. That's like a cup of coffee. In contrast, the average actively managed mutual fund charges over 1%, costing you $100 per $10,000 annually, regardless of performance. With Schwab ETFs, more of your money stays invested and compounding over time, avoiding fees that add up. All Schwab ETFs can be traded commission-free through a Charles Schwab brokerage account, making it easier to manage your investments. Schwab's platform is beginner-friendly yet powerful, providing research tools, automatic dividend reinvestment, and portfolio analysis. You might be wondering, why not just buy one total market fund and call it a day? That's one approach. The reason this 5 ETF portfolio stands out is because it gives you control and flexibility without complexity. It's balanced across income, growth, and global diversification. You can tailor it to your life stage. Common concerns. Diversification does not eliminate risk. You will experience ups and downs. Dividend ETFs prioritize quality. Keep an eye on market cycles. Growth ETFs can be volatile. Invest what you can afford to leave alone. Bonds protect, but are vulnerable to interest rate changes. They help cushion downturns, but aren't guaranteed safety nets. International exposure helps avoid home bias, but introduces currency and geopolitical risks. Start by assessing your financial goals and risk tolerance. Then, use this 5 ETF portfolio blueprint. Ask yourself, where do you want to be financially in 5, 10, or 30 years? And which portfolio aligns with your comfort level? This is not about chasing quick wins or predicting hot stocks. It's about steady, thoughtful investing. So, are you ready to invest smarter with Schwab ETFs? This portfolio offers clarity and simplicity. Before making decisions, always do your own research or consult a financial advisor to ensure it fits your situation. Don't forget to like, subscribe, and hit that notification bell for more data-driven investment strategies.